Okay, and welcome back, students taking Math for Business and Finance and Math Applications. We're almost done with the theory for Chapter 17, which was on depreciation, and this is the second part of the MACRS, the Modified Accelerated Cost Recovery System method of depreciation. So in the last video, I had stopped here at the chart to determine, the government will, based upon your asset, the government produces this chart that tells you how many years you have to depreciate that asset. Okay, so once you've determined what that is, let me get my pen here. We then come over and we look at this here annual recovery for MACRS chart. Okay, and since we were using an automobile and it told us that we had a 5-year class, what we do is we come underneath that particular column on this table, and these are going to be the rates that we're going to use for that period of time. Okay. Notice that they're, you have, 3 years, the 5 years, the 7 years, 10, whatever. They coincide with the useful life from that table. So if we've determined that we're going to use the 5 years, we're going to want to use these rates that are in the 5-year column. Okay. So you see we have 20%, 32%, 19.2%, 11.52%, and notice that there's an asterisk right here. Okay. And if you come down to the note, it says it identifies when the switch was made to straight line. Because remember, up here on this chart, we had an asterisk here, and it said that these classes use a 200% declining balance method, switching to the straight line method. Okay, and I had said we don't have to worry about calculating a 200% declining balance or the straight line. That is all figured into the percentage we're going to use. Okay, so as we have these percents, okay, as we have these percents here, when these percents up to here were based upon the 200% declining balance method, and when we got to the 1152 right here, okay, that's when it switched over to the straight line method. But we don't really need to be that concerned with that. All we have to be concerned with is what are these percentages: 20, 32, 19, 20, and so on and so forth. So, quick recap: we have our asset. We look on the chart to see where our asset is located at to determine our useful life. And in this case here, an automobile is at 5 years, right? Or whatever, to keep things consistent in the book, they're saying that this asset had a cost of $2,500, okay? But it's being depreciated over a 5-year period. So once we've determined that, we come to this table and we see our percentages that we're going to apply during that recovery year, right? Year 1, year 2, year 3, year 4, year 5. So we move down, and now we have to go and figure out what the depreciation amounts are, and of course create a schedule. Okay. Now, let me let's real quick here. Give me one quick second. Okay. So we start out creating our schedule, right? And of course this is our year column, and this is our cost, and it's $2,500. Notice it's the same all the way down, so you keep that all the same. And then of course we have to do our calculation for our depreciation expense. And we have an accumulated depreciation and a book value for the end of the year, just like we had for straight line, units of production, and the declining balance. We have these, these columns for the end of the year, right? So the real gist is in calculating the depreciation for each and every year. So we start out with, our cost being $2,500, but we have to go back to our chart and look at the percentage for year one. Now remember, we're looking at this here 5-year asset class, and yes, I am aware that it extends down to 6 years. Okay. The reason for that is because your situation, when you get down to the year 6, your value, remember I said everything goes down to a zero salvage value, a zero residual value. But that doesn't necessarily mean that we have, it has to go down to that amount right at 5 years. It's saying its useful life is going to be 5 years, but due to tax situations or whatever, those percentages extend beyond that in order to get down to zero. Okay, that's all in the background. We don't need to know any of that. Just be aware that, I can have I'm having a 5-year class, but I can, it doesn't have to be only 5 years. It can be greater than that. And that's all you need to know. Beyond that is beyond the scope of this book. All right. But our first year in this asset class, we're going to depreciate it by 20%. So we come down, and in our schedule, we take our 2,500 and we multiply it by that 20. And that gives us $500. That's our depreciation for this year. So of course, at the beginning of the year, the accumulated depreciation was 0. You've seen this before, plus 500 gives us the accumulated depreciation of 500. We take the 2,500 minus the accumulated depreciation of 500. That gives us a new book value of 2,000. All right, you've seen that before. Okay, so that's not like any new surprise. Okay, the new surprise here is how we're calculating the MACRS. Right here, the 20%. And of course, these are just for illustration purposes only in order to determine the depreciation. All right, so we depreciated $500 for the first year. Okay, now in the second year, we're told that we have to use 32%. Okay. In our second year, under the 5-year column, it's 32%. So we come down and we take, and this is relatively simple. We take 32% of the 2,500, right? There's the math, and that gives us $800. Okay, so that's our depreciation for year 2. And of course, for accumulated depreciation, 500 the previous year plus this year's gives us our total accumulated depreciation. And 2,500 less 1,300 gives you 1,200 for our new book value. Okay, I don't have to be concerned about carrying that book value over like I did with the declining balance. That's all factored into that, those percentage amounts. For year 3, when we go back up to the chart, we see that it is 1920. So year 3, we take the $2,500 times the 19.2%, 19.2%, and we get 480. 13 plus 480, 1780. 2,500 less 1780 gives me a new book value of 720. Now, I'm not going to bounce back and forth for years 4 and 5 here because you get the gist. Okay, here's my next percentage that I'm multiplying by 25%. Here's my next percentage at the end of year 5 that I'm multiplying by 25%. Now, even though it's in a 5-year class, notice that I have $144 remaining of book value. Okay, and like I had said, with MACRS, you're depreciating it down to 0. So even though you're choosing an asset class that has 5 years, you're going to depreciate it every year until you get down to the year 0, regardless of how many years that is. Okay, when you look up here on, and the reason why you're seeing that is because of the switch to straight line. Okay, when they're switching to straight line, it allows us to get to a value of 0. We can't keep on using percentages, because if we keep using percentages, the book value just gets smaller and smaller and smaller, and we never ever get to 0. So they have to switch to straight line in order to be able to take a specific amount that allows us to get to 0. But when you look at these here, these asset classes, okay, I mean, here's 7 years. Notice that goes to 8. Okay, here's 10 years. Notice that goes to 11. You know, here's 15 years. Notice that goes to 16. Okay, this is not a complete table. All right, it's a partial table, and like I said, you can get a complete table from the IRS if you want. But really, that's all there is to, the last part of MACRS. Okay, so as a recap, when you have your asset, and you have to look and determine what your recovery period is in useful life, whatever that may be. You're looking here and you're scanning through, you're trying to figure it out. Definitely read more than one, because I've come across situations where I thought it was in this time frame, but in reality it was in a different time frame. Okay, in this book it's not going to be that complicated, but those that are moving on into financial accounting, and especially intermediate accounting, you're going to see this all again. So just be aware of that. So I determined my number of years. Then I come over to this next table, the annual recovery table, in order to determine my percentages. Okay, and then all I'm doing is I'm taking those percentages and I'm taking the cost times whatever percentage it is in order to determine the depreciation expense for that particular year. And I do the accumulated depreciation column because this is a schedule, right? And so I have a running total of my accumulated depreciation, and I have a running total of my book value as it decreases down in value until I hit a 0 amount, right? So, if you don't understand something, go ahead and rewatch the previous video, and hopefully in combination with this video it makes a little bit of sense, a little bit more sense. And if it doesn't, then definitely telephone or contact an instructor and we'll go over it with you. Obviously anybody doing vet tech or medical, you're not going to really need to know this that much, but anybody who's in any business curriculum, nail this, get this down now, okay? Because like today, I just had a student who was in financial management, and he was asking a question about something that had been covered in Math for Business and Finance, financial accounting, and managerial accounting. He had seen it 3 times, yet he didn't know it when he was going into financial management. And I'm wondering how he was able to get past those other subjects, not knowing certain concepts. And definitely, if you're an accountant, you're dead in the water by that point in time, because you're going to see it in intermediate accounting, and you're just dead in the water, period. And that's why the dropout rate for anybody who wants to be an accountant is about 50%. Okay, and when you get into intermediate, about 50% of students drop in that first intermediate one, but that's a whole other story. Right, anyway, so this is the end of the theory videos, and I will see you all for the drill problems and the word problems and the summary practice test.